YouTube users, and Instagram. Hello, everybody. So the big story this weekend is the G20 meeting, and the whole world is watching what's going on. But for those of you who are interested in the actual stock business, it's actually much, much more important than usual. The G20 does not usually move the stock market. It might this weekend because of the situation regarding tariffs and China. As you know, the president has imposed tariffs on roughly $200 billion worth of goods coming in. They're 10% right now. They're going to go to 25% on January 1st. He's threatened to add additional $237 billion in tariffs. So there's an escalating threat here. And it's starting to impact and weigh on the global economy to a certain extent. A lot of debate about how much it's weighing. The bottom line is it's having some impact on not just real numbers, but psychology. Remember, a lot of the game regarding global commerce is a confidence game. You have to feel like business is getting better, things are getting good, and you generally spend more. It really does get down to that, believe it or not. So there's a lot of interest, very keen interest, in resolving the tariff issue. The bulls are hoping, some are betting, that the president will essentially make a deal that will involve essentially a truce. He's not going to back off. He's not going to say, I don't want a better trade deal. I want better protection against information technology theft, which is a very real problem. He's right about that. But for the moment, let's just not impose any new tariffs. Right? On January 1st, I'm telling you we're going to do it. Now I'm saying we'll just hold off and we'll continue to negotiate. And if I don't get what I want in the early part of 2019, we'll put on those tariffs again. Believe it or not, just a ceasefire would generally be greeted positively by the markets, because at least it would add some better certainty to estimates on earnings for 2019. That's what this is all about. Remember, everything goes back, if you're an investor, everything goes back to what the stock market's doing, and the stock market is reacting to earnings. Earnings are a play on the value of a company and an estimate on the forward numbers. We're not interested in the third quarter or the fourth quarter. We're trying to figure out what's going to go on through 2019. And professionals have models. So if you are with Alcoa or United Technologies, you're going to make an estimate on how much you think they're going to earn in 2019. But if you think tariffs are going to be really high, if you think the dollar is going to be really high, if you think the global economy is going to slow down partly because of tariffs, your numbers are going to be lower. So we don't know the answer to these questions right now. And that's why the stock market's been going up and down like this. It's so crazy and difficult to figure out. Because the things that matter, the global economy, tariffs, and to a lesser extent what the Federal Reserve is doing, I'll talk about that in a minute, have been very uncertain. So this uncertainty causes people to withdraw or put more money into cash, creates more volatility. So here's the bottom line. If the president can come away from this meeting with some kind of agreement with China, even if it's just, okay, we're not going to impose any more tariffs than what we've got now, and we're going to negotiate, the market will greet that positively, and we will be up on Monday. If he doesn't, they look like they can't stand each other, the president of China, President Xi, and President Trump, we will probably react negatively. It actually really does get down to that much right now. And this is going to impact a lot of other things around the world, like I said, global sentiment. What else do we want to talk about? Great.
So another piece of news this week was a speech by the Fed chair. I was wondering if you could talk a little bit about that.
Okay. So the other question, this is makes sense, is about the Fed chair Powell's speech this week. He gave an extraordinary speech. I encourage you to go look at it, where he talks about global risks that are out there. But again, get down to the point, what's the bottom line? What's it going to mean for earnings in 2019? The other thing the market's freaked out other than tariffs is what's going on with interest rates. Now, the Fed has been slowly hiking interest rates for the last year and a half, and the bottom line is it's had a moderate effect on the stock market. I can't say it's been disastrous, but they're starting to get concerned because the Fed has indicated a little while ago that the economy is so strong that they're going to keep hiking interest rates into 2019 and maybe beyond. Now, the history of the stock market, when you're in a bull market, and by the way, we are in a bull market, okay? If you go back to 2009, this has been one of the great bull markets of all time. What kills bull markets is two things. Number one is a recession. We are not in a recession. Nobody I know thinks we're going to have a recession in 2019, so that's highly unlikely. The other thing that kills bull markets is the Fed raising interest rates more than the stock market thinks the economy can handle. In other words, the Fed overplays its hand. This has happened a number of times. And there are a number of people who've been sounding alarm bells recently saying, you know, the way the Fed's been talking, they're acting like they're going to do 4 interest rate hikes in 2019 on top of 1 in December. I don't agree with that. I have a problem. And there's a lot of people who've been screaming their heads off about this. Powell's speech on Wednesday was a masterpiece in that he did not change his position. Remember, the Fed has 2 mandates. One is the economy, is specifically employment. They're supposed to watch that. The second mandate is inflation. They're supposed to keep it under control. This is called a dual mandate. A little tough to do 2 different things at once. But Powell came out and said, you know what? I'm not changing my position. The U.S. economy is strong. We think it will be strong. Inflation is slowly moving towards our target. Their target is 2%. And that's essentially his position. But he inserted one line in there that said we are just below the Fed neutral rate. Now, the neutral rate is a very vague term, but essentially it's the rate at which the Fed would set short-term interest rates that are not stimulative nor too accommodative. The bottom line here is he implied that they weren't going to hike rates as much as a lot of people thought with that one sentence. Now, again, this is masterful because he didn't change his outlook on the economy or inflation. He didn't. But he implied we're getting closer to stopping raising rates. So how many more rate hikes? That's what everybody's debating. Right now, the Fed fund targets right now is 2 to 2.25. That's where they're at right now. The implication was maybe we'll do 3 or so more rate hikes or so. Again, this is debated where the exact number will be. But instead of 4 next year, a lot of people are now down to 2 next year. The market loves that because now we have a little better certainty, a little less probability they're going to make a mistake and hike too much. That's why the market rallied 600 points this week. Better certainty on the earnings picture because they now think they're not going to overshoot too much. So this was a masterful little piece of speech writing, and I encourage you to take a look at Mr. Powell's speech.
Absolutely. Awesome. So continuing to look forward, we're about to enter a new year. What sectors should we have our eyes on? What
Sectors. Well, what's interesting, if you look at the last month, November's been very volatile. You know, the Dow moved like 2,000 points, top to bottom in November. That's a lot. That's almost 8%, 9%. That's a lot to move. And that's a sign that they're unsure what's going on. There's been a lot of money moving around. So if you watch, a lot of money came out of technology stocks and into healthcare. Now, why did that happen? Well, healthcare is a little safer. It's more defensive. It has a fairly steady growth trajectory, not as much as some tech names, but again, a lot of interest. Why? Well, we're all getting older. Baby boomers like me need health care. They need pharmacy benefit managers. You need health hospitals. They need HMOs. They need pharmaceuticals. This business is, it really is that simple. The business just keeps growing on that basis. So money out of tech into healthcare, also money out of consumer discretionary. Now, don't get fooled about consumer discretionary. It's retail stocks, but it's also a small group of super growth FANG names, specifically, of course, Amazon, that's there, and Netflix as well. Those 2 stocks got pummeled along with Twitter, and that's the reason we saw the consumer discretionary group down. Now, so for 2019, here's what you want to look at. Oil is a big problem right now for an investor. It's great for a consumer. Oil was down 20% this month. Energy stocks were down 3%. That's very unusual. And the reason energy wasn't down as much is most of the drop in oil is because demand was, supply was greatly inflated by the fact that the Iranians essentially were still very much in the market. And that's a problem. If there was a demand problem, if everybody thought, wait a minute, the global economy is falling apart and demand for oil is going to go down, believe me, oil stocks would have been down 15 or 20% in November. But they're only down 3% because it wasn't a demand problem, it was a supply problem. I know that's a little esoteric, but that's very hard to figure out right now. Oil is a really tough thing to figure out because it's so dependent upon how much supply is actually in the market. For 2019, here's what you want to look at. Resolve the tariff issue, okay? Give me an answer to this right now. I'll tell you things will be much more stable, number one. Number two, there's another problem with a little bit of inflation. So what we call input costs have been going up a little. Partly this is tariffs, but there's been higher prices for a lot of commodities recently. So companies that are packaging, companies that send things out like cardboard, prices have gone up. Companies are trying to pass that on. It's not clear how far that's going to go. Right now, it looks like inflation is not out of control, but in small parts of the business, it's a little higher. I would keep an eye on that. The other thing that, if you could tell me what would happen, I'll tell you what earnings are going to be, is the global economy ex the United States. Europe is generally slower than we are, and I would describe Europe as flat. I would describe China as, well, the GDP is probably still going to go up 6% in 2019, but a lot of people are unsure about how valid that number is, number one. And number two, believe it or not, that's a significant slowdown from where it was a few years ago. So China's still growing, but at a slower pace. And the big question is how much the local Chinese are still going to be buying foreign goods if there's a trade war. So that's why resolving the trade war is very important. Japan's about flattish to up less than 1% in their GDP. That's another issue that's out there. So global growth is another big problem. Overall, look, we've had an amazing run in the last 10 years. I mean, think about what the market has been up. More than 200, close to 300%. So it would not surprise me if we were flattish next year on the stock market. And remember, I generally tend to be in the long term bullish. The reason I'm long-term bullish is because that's the whole history of the stock market. You're an idiot if you don't look at it and say the market tends to rise rather than tends to fall. That doesn't mean there aren't down years. We all know there are. So I can't tell you if the market's going to be up or down next year, but I can tell you in terms of historical patterns that go back to the 1940s, I can tell you that there's a thing called mean reversion where historically the average growth in the S&P 500 has been 6 or 7% a year. That's the average. We've been doing way above that for the last 10 years. So what's called mean reversion indicates that you should get somewhat lower returns. This is exactly what Vanguard said this week. We were at Vanguard headquarters. We talked to the CEO, Tim Buckley, the chief statisticians and information officers there. And the bottom line is that's their conclusion. It's not just me talking. They looked at the numbers too, and they're expecting somewhat lower returns. It doesn't mean zero or negative necessarily, but lower than what we've been doing here. So here's the bottom line. Don't try to time the market. If you think you want to be a professional investor and go in and out of the market, good luck. We've got plenty of shows with really smart people on them that you should be watching. But for most of you people out there, unless you're expecting to die or need the money immediately in the next 2 or 3 years, staying long in a diversified portfolio, yes, I know it's boring, but it's the safest way to go. Figure out what level of risk you're comfortable with. 60% stocks, 40% bonds, whatever. Maybe more comfortable, fine. But remember something. Look at me. I'm 60. I'm in my 60s. I'm expecting to live into my 80s. Do you think I'm going to do something, expecting to live into my 80s? I have a longer-term perspective than whether the S&P is going to be up 1% or down 2% next year. Think longer term. That's the way you want to work. Sorry to be so long-winded. I feel very strongly about that. What else do you want to talk about?
Great. We just have one more question. We're talking about volatile market this last month. Apple has had a particularly volatile time. I'm wondering if you could talk a little about
Well, it's a little awkward for me. I don't make recommendations on stocks at all. I'm a big Apple fan. I own all sorts of Apple products. I bought into them because they work, and it's an ecosystem that works. And that's millions of other people have decided that. More than 60% of the revenues of the iPhone business. The smartphone business, generically, it doesn't matter whether you're talking about Apple or Samsung, is maturing around the world. I mean, believe it or not, a lot of people who want smartphones, the majority, have them already, even in China, where there's much lower cost smartphones. They compete against Samsung, Huawei, some of these guys that are out there. And hundreds of millions of Chinese have smartphones now. So if you think of this, I know this sounds strange because it's still a relatively new product, but smartphones are a maturing business that's out there. Apple stock has been so amazing, it's acted like a startup. It's really incredible. So nobody should be shocked that Apple stock is looking like it might be plateauing. I don't know if it's going to be up or down. But if you think of the primary business, the iPhone, smartphones are a maturing business. Now, the question is whether Tim Cook can broaden into other areas. So they're looking at augmented reality. They're looking at expanding out the music section. They're looking at expanding the services. They're looking at all sorts of weird things. They're even working on an Apple car. Now, maybe all these things will blow up and be fantastic, and Apple, will be a $2 trillion company in 7 or 8 years. I don't know. I know the existing suite of products they have generate stupid amounts of cash flow. Enormous. The company's sitting on more money than most companies are worth right now. So Apple will do fine. Just recognize the maturity of the smartphone business. That's it for this week. Always a pleasure to talk to everybody. And remember, make it safe. Don't do anything crazy. One final thing. There are 8, 9, 10 days of the year when a substantial majority of all the profits in the stock market are made. Here's the problem. I don't know what days those are. Nobody does. But if you think you can go in and out of the market and time that, and you're out on those 8 days, your returns will be much. Someday I'll show you